Hello everybody, it's me the Boss Hog, and today we're going to look at my portfolio as of the week ending the 21st of January. Pretty interesting week, so let's walk through it. Alright, so first of all, we're trying this video with some headphones in with a mic, see if it improves the sound quality. Was talking with somebody in Discord, said I'd give it a go, so just a slight tweak in the setup. In terms of the week, I mean, it was pretty volatile. I'm sure anyone who's invested experienced it as well. Honestly though, I have a pretty balanced portfolio, all things considered. So I was only down about 1% on the week, and I'm down about 0.7% in January so far. I do take pains to try and make my portfolio balanced, but even still, yeah, it was difficult to navigate. I know, other YouTubers have seen much larger drops. I think you'd have to have quite a risk-adverse portfolio to not have seen any drop, or maybe been very lucky in a couple of large holdings. Not sure. So I'm actually fairly happy with the performance over the last week. It was a shame that Friday was a bit brutal, and a lot of my US shares in particular were absolutely hammered. In terms of material movement, Games Workshop was down 4%. However, I was buying at the bottom, so that felt pretty good on now, as we'll get to in just a second. Poly here is my main gold hedge, so it did exactly what it's meant to be doing, so that felt pretty good. Amcor, again, we're going to get to that in a little bit, but this is a fairly small semiconducting testing company. It's something I've been building a stake in, and likewise took the opportunity to do just that. Disney, likewise, I semi-dodged a bullet here, but I still have a reasonable holding, and again, we'll get to that a bit more in a second. WH Smith here has been on a recent good run. It really pulled back heavily in November. I wish I'd been slightly braver, because I think it's a very well-run company. We should bounce back really well, but ultimately at the moment it is impacted by any sort of travel restrictions and anything like that, but still it's had another good week after previous good weeks as well. And Salesforce as well, which I'm looking at quite closely at the moment, also down 5%, so not a great week from that perspective either. Yeah, I would just add, as well as my balanced portfolio, I'm fairly light on tech. About 12% of my portfolio is tech, and also I'm fairly underweight in US stocks as well. So like the FTSE 100, I might be wrong in saying this, but I think it's the only major index which is positive for the year to date. If it's, I mean, yeah, again, that's what I read on Friday. So it helps the fact that I'm 65% UK stocks. The main reason for that, by the way, is there's a lot of like value, not much tech, high dividend paying companies that have done fairly well comparative to other sort of sectors, so that's helped as well. And likewise, my portfolio itself does have some value plays, some recovery plays that are doing quite well as they recover, so that's been helpful. Likewise. No capital added this week. I mentioned last week that I'd put basically everything I had left for January in. I am looking to add some on the 29th of January when we get paid, so I guess that will squeeze in next week, and I'll see if there's anything left, but for now no more capital to be added. There was reduced trading this week, but I mean this is still over 6% of my portfolio, so it's still a pretty active week considering this is just 1 week. So yeah, as you'll see in a second, and just the one dividend this week. I actually didn't even realize I'd be getting this one. I had one share in dividend, one share in Everest, just to monitor the share price, etc. I have now increased my position to about 200 shares, but obviously I forgot that I'd basically qualify for one share's worth of dividend, so fine. But yeah, very tiny one this week and not much more to add. So let's have a look first of all what I've been buying this week. Alright, so first of all, Games Workshop. Now, I did a video on this last week. I looked at the numbers, and basically I felt the more I researched, the more I convinced myself. When the share price dropped under £80, I decided to make a move, basically. I'm really happy with this buy price. I think it's, honestly, there's like 50% upside at this kind of level. My average, even after, the commission and fees and that kind of stuff, there's like stamp duty in the UK, you have to pay 0.5%, still kept it under 80. So for me, this is a complete bargain for a quality company that I think, has had an overly done pullback, basically. So really happy to have quite significantly improved my position in Games Workshop. Next up is Amcor. Obviously, we touched on this. So I was buying Amcor in 3 chunks, almost evenly split, so my average here was just under $23. Obviously, I wish I'd held off longer, so I picked them all up at 22, but that's the nature of things. I have kind of a high 20 target price for this. I wish I could be a little bit more accurate, but if I'm honest with you, my stake's probably ahead of my DD at the moment, so I need to spend a little bit of time there, but I'm very comfortable buying it under $24. I am down a little bit at the moment by about 5%, but again, I feel really happy. I'll be buying some more shares if it goes under 21, under 20, and so on. So my plan here is just to average into what's become a profitable company that I think is going to scale very nicely. Again, it fills in a couple of gaps for me as well, right? It improves my American exposure as well as my tech space. So again, it's ticking a lot of boxes for me. Disney I bought after the fall here, which fell in sympathy with Netflix primarily, as far as I can tell. So I got a pretty good price for this, like $138 is what that £101 looks like. And yeah, relatively happy. Honestly, pretty happy with that. I still like Disney in the long term, and I'm happy to be buying at that kind of level. So I guess we'll see if that turns out to be a good buy or not. I did just want to spend a minute or two on this one. So this is a company that I owned before in the very early days of my investment journey, and made some pretty good money on it. I was like buying under $14, sold just above 17, I think. So I was pretty happy with that turnaround, and decided to just profit take because there was risks. And I'm not going to pretend like this isn't a semi-risky play, especially when you've got a bunch of very good REITs that you could buy, right? But a lot of the REITs are pretty up to date with current valuations, I would say, even above. Macerich trades on an 8 FFO. If you compare it to its competitors, like Simon Property Group is probably the best one. They're trading on like almost a 14 FFO, right? And there are some good reasons for that, to be clear. Like Macerich is very indebted. It was over leveraged when restrictions struck. Being a mall REIT, it's going to be influenced by that. But it's basically got like 50 very high quality malls in like growing affluent areas. It's been able to increase its pricing, its occupancy is above 90%, its debt's coming down. There is a risk of dilution here, I'm not going to lie, so I haven't got a huge stake in this, but I did want to spend a little bit of time talking about it, because again, the more I read this, the more I think this is a really good value play. If it can get up to like Simon Property Group's FFO, you're looking at like a $24, $25 share price here. Even if it's like somewhere between, you're looking at like $22, and I'm picking this up at just over 16. So it feels pretty good, like lots of safety margin there. And if you look at the yield, which is about 3.7% at the moment, even if Macerich were only paying out about 50% of their earnings, which they're not, by the way, they're using more than that to pay down the debt. But if they were that, and they kept the same yield at 3.7%, then the share price would be worth $28. So depending on where exactly you want to do it, you can make arguments for this being anywhere between about $21 and $28. But again, for where I'm buying it, there's at least a 30% margin of safety here. So I think there's enough safety for me to start building a stake in this. So I'm going to be doing just that. Basically, I will be buying more Macerich, probably anything under, maybe even 18, but certainly anything under 17 I'm going to be buying. And if it's underneath that, then I'll be buying more aggressively. So again, I think there's some value to be had here. And last but not least, I just wanted to address Ceridian, which again I'm starting to build up a stake on. It had a very small fallback, so it's now basically in line with my average buy price. So I bought another 9 shares here. This is basically my day job. It's a telco billing and CRM provider, which is literally what I do for a living. I have no relationship with this company, just to be clear. I just like the direction that they're moving in. Also, as well, a lot of what they've done has kind of built a foundation that now should scale. They're starting to win 8-figure orders, and it's still a very small company, about 250 million market cap, so very small to be sure. But forward PE of 35, again, not so cheap, but also not super expensive. This is a technology-led company that's actually quite difficult to find fault with. Probably the only fault that I would call out is the fact that at the moment a lot of its revenues aren't recurring, so about 65% of them aren't recurring. Obviously, you'd want to see that change, but I think there are some good reasons for that as they pick up larger customers, as they do these projects. Hopefully, they will turn into more of a subscription-led a provider, and that is what I'm expecting to see. So again, I know this space super well. I'm actually very happy paying this kind of money for it. Really, anything under £9 for me is a very good buy price here. And yeah, at 860, which is my current average, I think this is a real steal. So I just wanted to kind of talk about them a little bit as well. I think they deserve some love, basically. Also, the CEO and the founder, or kind of spun it out of an existing something 30 years ago, still has 30% of the shares. So again, this is the guy's going to want to be building a business in the long term as well. So it's a slow grower, but it's now kind of reached that point where it's got the scale and it's going to start picking up more business, and it's going to be its marginal costs aren't going to be as increasing anywhere near as fast as its revenue growth. So I think this is going to really start throwing off cash basically in the over the next few years. So I want to build up a stake while it's at this kind of level. So anyway, they're my buys. Obviously, I haven't highlighted everything here just because I feel like I've spoken about them in the past already. If anyone does have any questions, just drop them in the comment and I'll do my best to reply. But for now, let's look at the sells. All right, so first of all, I do realize that Disney is also on this list. There was a reason for that. So first of all, I sold Disney $151, basically flat. These shares sat outside of my ISAs in what's called a general investment account for anyone not familiar with trading 212. And I did this to free up the money to buy Games Workshop, which also sits outside of there. And for tax reasons in the UK, and because our ISAs are already filled up, basically the companies I put in the general investment account are kind of very low yielding companies but have a lot of growth potential. So actually Disney and Games Workshop right now both fall into that category. So they were there, and I just decided to sell Disney because I felt like I still think Disney has some good upside, but nothing like Games Workshop, right? Like if I genuinely believe, as for my other video, the Games Workshop are worth £120, I'd be mad not to be buying shares at £80. I have no more capital to add, so I was like, do you know what? I'm just going to take the the wipe effectively on Disney and put those 43 shares, so like 2/3 of my holding, slightly above. Went into there, and you can see here my average sell was £110, so that's almost 10% higher than what I was buying them back at, right? So again, I would be more than happy to buy back the Disney, now the ones that are in my ISA account, where they're just in a different place basically. So that was kind of partly the reason for that, was just to free up capital. And yeah, like I say, I still like Disney, whether it's under 150 or under 140 or even lower, who knows where the market's going to go. I decided also to sell off Microsoft. This is very similar. I had 2 shares in my ISA account that I picked up for 301. So selling them at 306 is hardly like making tons of money. But again, here I wanted to make a good opportunity to buy some more Amcor. So I did just that. So I think I'm okay with this, honestly. Like, Microsoft's a very expensive share, although every time I think that, it then posts like record earnings and I look silly. But I would say that like if you think that maybe they're going to make $10 earnings per share, maybe it's a 35 forward PE kind of company. We're just talking about that with Ceridian, right? Like the argument is that normally these large companies can't grow at the same speed as the slower ones. Makes sense. But Microsoft's been on fire for years and is arguably, the best company in the world that you could take a stake in. So it's kind of up for debate whether this is a good sell or not. Right now it feels pretty good for me. And, again, Microsoft, I mean, I think it's expensive, so I just took a little bit of profit. Whereas, and again, I think Amcor here has 30% upside. So again, I think that's a very defensible position to take for me, and I feel good about it. So that was my reasoning for that as well. I just wanted to talk about this because obviously I just mentioned I put a big bet on Games Workshop, and here I am selling stuff. But this is again, for anyone who's new for my channel, I don't really like fractionals. Like when I'm building a position, I will take fractionals, especially like if I think the price is really good and I just want to throw money at it. Basically this happened with Games Workshop. I ended up with like 0.6 of a share, and I got to the point where I was like, do you know what, I'm now happy with my stake. I think I have 125 shares in Games Workshop, so it's a top 5 holding for me. As a result, and this is literally just to give me that round number rather than having point so that's why I did this. I'm not going to spend any time talking about National Express. These are still my largest company, and I'm basically selling them down about 15% profit at the moment, just to kind of de-risk my portfolio a little bit from this company, although I do still think there's about 20% more upside with National Express even at these prices. My plan is to sell another 1,000 more of National Express, at least, and then see where we go from there. But it's basically like my piggy bank at the moment in one of my ISAs that I'm selling down positions in, and my wife's ISA as well also has both BMY Bristol Myers as well as Hollywood Bowl that I'm looking to do very similar with. So they're kind of being very slowly sold to a point, because I like all of the 3 companies I've just mentioned, BMY, Hollywood Bowl and National Express, but I'm basically selling a couple of hundred each week and then using that money to redistribute. So I've still got 9,000 shares in National Express, I think 2,000 Hollywood Bowl, and I think 270 in Bristol Myers. So again, I'll be keeping the majority of those positions. It's just basically freeing up some cash to buy the dip. And speaking of, like I say, I'm not quite sure whether this is the start of the bear market or not. I haven't really talked about it. It's not really my style to be like sensationalist, but I have to say it is a pretty sharp fall. I mean, I've only been investing for like 15 months, so I didn't get to witness the March 2020 route that happened. But it's like I'm watching it unfold, and I'm pretty glad at the moment I'm not more exposed in those areas. So hopefully I can continue to navigate this reasonably well. And if anything, I'll just treat it as an opportunity to be buying American shares and tech shares, which have been quite expensive. And I found it quite difficult to build positions in them, which is why I don't have big positions in them. Basically, like when I first started, my aim was to have no less than 40% in the US and the UK, and then, you know, whatever was the difference. But I've just, you know, like the UK to me still has quite a lot of value, whereas the US still looks expensive, certainly at an index level. Though I would say, you know, if you like want to look at individual shares, there's some good things to buy there, right? Like BNY for me would be a good example. I think EPD is a great shout as well, and, you know, one or two others in there as well. So that's going to be my focus, I think, for the next few weeks, just to try and navigate this as best as I can, not fall into any like bull traps and assume that we've hit the bottom. I'm just going to like reduce my large holdings very slowly, profit take on all of those things that I've just mentioned, build up my American stake if those opportunities arise, as well as tech stakes for the same reason as well. So looking to buy things like Amazon at the moment starting to look really tempting to me. CRM if it goes under 210. Amcor if it goes under 21. So I've got like a bunch of targets. So I expect to be relatively heavy trading for the next few weeks, assuming that the market continues to be difficult to navigate, and we'll see if that works out well in the long run or not. That's the plan. So that's everything from me. Again, I'll actually appreciate feedback on audio as well. If this is better, let me know and I'll keep it up. Otherwise, thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.